Ryan buys a duplex. Elena buys index funds. Both of them think they just made the smartest financial decision of their life. Both of them are wrong, because one of them forgot to count the hours, and the other forgot to count the compounding. And by the time you see what actually happens over 20 years, you're going to question everything you've been told about getting rich. Let's make this fair from the start. Ryan and Elena both have $60,000 saved. They both make $62,000 a year. Same age, same city, same starting line. The only thing that's different is what they do with that 60 grand. Ryan takes his $60,000 and puts it down as a 20% down payment on a $300 duplex. 2 units, one on each side, in a neighborhood that's up and coming, which is realtor language for give it 10 years. He takes out a 30-year mortgage at 7%. His monthly payment comes out to about $1,600. He rents out both units for a combined $2,200 a month. On paper, that's $600 a month in pure profit before he spent a single dollar on anything else. Ryan feels unstoppable. He starts watching real estate videos every night. He tells his dad he finally figured it out. Elena takes her $60,000 and puts it into a total market index fund. She sets up an automatic transfer of $350 a month and never looks at it again. When people ask her what she's doing with her money, she says, "Index funds," and the conversation dies immediately. Nobody asks a follow-up question. Nobody's impressed. There's no story there. On day 1, Ryan has 2 tenants, a set of keys, and a story for every dinner party for the next year. Elena has a brokerage account and a confirmation email. It is not even close in terms of how it feels to be either of these people. But feelings and math live in 2 completely different rooms of the house, and only one of them pays the bills. For the first couple of years, Ryan is living exactly the life he pictured. Rent hits his account on the first of the month like clockwork. He drives past the duplex sometimes just to look at it. He's writing off mortgage interest and depreciation on his taxes, which knocks a few thousand off what he owes the IRS every spring. He's building equity every single month, and he watches the Zillow estimate creep upward like it's a stock ticker he personally controls. Everything about this feels tangible. It feels earned. Elena logs into her account maybe once every few months. The number goes up a little, dips a little, climbs a little more. Year 1, her $60,000 becomes about $66,000. Year 2, maybe $73,000. Nothing about this feels exciting. There's no tenant texting her at 11 at night. There's no asset she can drive past. Just a number that occasionally changes on a screen she barely opens. Ryan's friends ask him about the duplex constantly. Elena's friends have never once asked her about her portfolio. And that social gap alone makes Ryan feel like he's lapping everyone else in the race. Now let's actually look at the numbers by year 3, the way an accountant would, not the way a landlord brags at a barbecue. Ryan has collected roughly $79,200 in total rent over 3 years. His mortgage payments over that same period add up to about $57,600. That leaves $21,600 in gross cash flow. And if you stopped reading right there, you'd think Ryan made the play of the century. But you can't stop there, because that number is a fantasy. Property taxes run him about $3,600 a year. Insurance on a 2-unit property adds another $2,000 a year. In year 2, 1 unit's water heater dies and costs him $1,400 to replace. In year 3, a storm damages part of the roof, and he's out $3,200 for repairs. He also eats 1 full month of vacancy between tenants on one side, which costs him $1,100 in lost rent, plus $500 to clean and relist the unit. He manages the property himself to save money, which sounds smart until you realize what that actually means. Phone calls during dinner, a Saturday morning spent waiting for a plumber, texts about a broken garbage disposal while he's trying to watch his kid's soccer game. When you add up every real cost, Ryan's actual net cash flow over those 3 years is somewhere between $2,500 and $4,500. Not the $21,600 that looked so good on the spreadsheet he built the week he bought the place. And none of that accounts for a single hour of his own time, which, if you valued it at even $15 an hour for everything he's done, would erase most of what's left. Elena, meanwhile, has put in her original $60,000 plus $12,600 in contributions over 3 years. At a 10% average annual return, her portfolio sits around $91,000. She spent 0 hours managing any of it. No phone calls, no emergencies, no Saturday mornings lost to a stranger's plumbing problem. But here's where it gets interesting, because Ryan still has one enormous advantage working quietly in the background: leverage. His $300,000 property has appreciated maybe 3 to 4% a year, and it's now worth somewhere around $328,000 to $338,000. His equity, what the property is worth minus what he still owes the bank, has grown to roughly $75,000 to $85,000. That growth came partly from his own money and partly from the bank's money, and that's the one trick stock investors can never fully copy. The rent check is the number everybody talks about. It's the number on the thumbnail, the number at the real estate meetup, the number your cousin brings up every Thanksgiving. What nobody brings up is everything that quietly disappears from that rent check before any of it becomes real profit. Vacancy. The average rental unit sits empty somewhere around 3 to 4 weeks a year between tenants. That's not a catastrophe, but it is a mortgage payment with zero income covering it. And every time a tenant leaves, you're paying for cleaning, minor touch-ups, listing fees, and the hours it takes to screen the next person. Maintenance and repairs. The standard rule of thumb is to set aside 1 to 2% of a property's value every single year. On a $300,000 property, that's $3,000 to $6,000 annually. Some years that covers a leaking faucet. Other years it's a $7,000 HVAC unit that dies in the middle of July while your tenant is threatening to break the lease. Capital expenditures. Roofs last 20 to 25 years. Water heaters last 10 to 12. HVAC systems last 15 to 20. These aren't maybes, they're guarantees, and they show up in chunks of $5,000 to $15,000. If you're not setting money aside every single month for these, you're not investing, you're gambling on timing. Property management. Hire someone, and it's 8 to 10% of your monthly rent gone immediately. Manage it yourself, and you're running an unpaid part-time job that never clocks out. And then there's the risk nobody wants to say out loud: a bad tenant. Someone who stops paying and understands exactly how slow the eviction process is in your state can cost you 3 to 6 months of lost rent plus legal fees. One bad tenant can erase an entire year of profit in a single stretch. None of this shows up in that clean $600 a month number Ryan told everyone about at the barbecue. But it shows up eventually. It always does. By year 5, Ryan is deep in the actual experience of being a landlord, not the fantasy of it. He's on his third set of tenants across the 2 units. He's replaced the roof for $9,200. He's had a plumbing emergency that cost him $1,600 on a Sunday, which always seems to be when these things happen. He's raised the rent to $2,500 combined, which helps, but his taxes and insurance have also crept upward. His actual cash-on-cash return, meaning the money he pockets relative to the money he originally put in, is sitting somewhere around 4 to 6% after every real expense is subtracted. Respectable. Not the 18% he quoted his brother-in-law at Christmas. Elena is still doing nothing, which is the entire point. Her portfolio has grown from $60,000 to somewhere between $160,000 and $175,000 by year 7, including her monthly contributions. She never picked a stock. She never tried to time a dip. She never did anything except leave it alone. The compounding is starting to pick up speed now. The gains on her gains are generating more new wealth each year than her actual contributions are. Here's the part that's easy to miss while you're living through it. Ryan's wealth is growing, but slowly, and only with constant attention. Elena's wealth is growing along a curve, quiet for years and then suddenly loud. Compounding is boring for the first 5 years and almost unbelievable for the next 15. By year 10, Ryan's duplex is worth somewhere between $390,000 and $410,000. His remaining mortgage balance is around $205,000. That puts his equity at roughly $185,000 to $205,000. Over that decade, after subtracting every real cost, mortgage interest, taxes, insurance, repairs, vacancy, and the capital expenses, Ryan's total money spent beyond his original down payment lands somewhere between $25,000 and $40,000. Elena's portfolio, with her consistent $350 monthly contributions and a 10% average annual return, is sitting around $195,000 to $215,000. She put in $60,000 up front plus about $42,000 in contributions, roughly $102,000 total. Everything past that is pure compound growth, and she spent exactly 0 weekends fixing anything. At the 10-year mark, they are shockingly close. Ryan might be slightly ahead because of leverage, but Ryan also spent hundreds of hours managing the property, took on hundreds of thousands of dollars in debt, and put his entire investment into one building in one zip code. Elena spread her money across thousands of companies and never lost a single night of sleep over a broken water heater. This is where the story really starts to split. By year 20, Ryan's duplex is worth somewhere between $550,000 and $600,000. His mortgage is paid off, or close to it. His equity sits somewhere between $500,000 and $580,000. He's collected rent that entire time, but after 2 decades of maintenance, turnover, taxes, insurance, and at least one major renovation, his total net profit from cash flow alone is probably somewhere between $50,000 and $90,000 above what he spent. Maybe more in a booming market. Maybe less if the neighborhood never quite came up the way he hoped. Elena's portfolio, at a 10% average annual return, with her $350 monthly contribution, has grown from $60,000 to somewhere between $500,000 and $560,000. That's with total contributions of around $144,000 over 20 years. The rest, well over $350,000, is pure compounding. No debt, no tenants, no 2 a.m. phone calls about a broken pipe. When you line up their net worth side by side, they land in almost the exact same neighborhood, somewhere between $500,000 and $600,000 each. But the road they each took to get there could not look more different. Ryan worked for his number. Elena waited for hers. Ryan carried stress, concentration risk, and an asset he couldn't sell in a weekend if he needed the cash. Elena carried volatility, but she also carried liquidity and freedom. And here's the detail that changes everything. If Elena had simply bumped her monthly contribution up by $200, from $350 to $550, her 20-year total jumps to somewhere around $650,000 to $700,000. That's the strange magic of the stock market. Increasing your contribution has a multiplied effect through compounding. In real estate, increasing your investment usually means buying a second property, taking on a second mortgage, and doubling your workload just to double your exposure. Now, if I only showed you the downside of real estate, I'd be doing exactly what every stock market influencer does, which is telling half the story and calling it the whole thing. So let's be honest about what index funds actually cost you too. Volatility is brutal, and it is not theoretical. In 2008, the market dropped by roughly 37%. In March of 2020, it dropped 34% in a matter of weeks. If Elena had $180,000 sitting in her account and watched it fall to around $115,000 in less than a month, that is not just a number on a screen anymore. That's the kind of thing that keeps people up at night, and it's exactly why the data consistently shows that most retail investors panic sell during a crash and buy back in only after the recovery has already happened, locking in the worst possible version of the outcome. There's also no real cash flow. Unlike a rental property, index funds don't hand you a check every month that you can actually spend. Dividends exist, but on a total market fund, you're looking at maybe 1.5% to 2% a year. On a $200,000 portfolio, that's roughly $300 a month. That's not replacing anybody's paycheck. There's no leverage either. Elena used $60,000 to control $60,000 of assets. Ryan used $60,000 to control $300,000 of assets. That 5-to-1 leverage is enormously powerful when property values climb, and it's one of the biggest reasons real estate has historically produced more millionaires than the stock market in a lot of surveys. And there's no tax trick quite like depreciation. Real estate investors get to deduct the theoretical decline in a building's value from their taxable income, even while the property is actually appreciating in the real world. That is a completely legal tax shelter that stock investors simply don't have access to, at least not outside of a retirement account. So where does real estate actually win outright? It wins when the rent-to-price ratio in your market is strong, meaning the monthly rent is close to 1% of the purchase price, because then the cash flow math works in your favor from the very first month instead of fighting you for a decade. It wins when you treat it like an actual business instead of a side hobby, screening tenants seriously, budgeting for capital expenses before they happen instead of after, and building real systems instead of winging it. It wins if you house hack, meaning you live in one unit and rent out the others, because that can push your own housing cost close to zero while your equity still climbs, something the stock market has no equivalent for. And it wins if you understand a 1031 exchange, which lets you roll profits from one property into the next one without paying capital gains tax immediately, letting your real estate portfolio grow in a way that stock investors can't fully replicate outside of a retirement account. Real estate isn't a bad investment. It's a misunderstood one. And the stock market isn't some guaranteed shortcut either. It's just misunderstood in the opposite direction. Ryan and Elena both walked away from their decision at the very beginning thinking they'd found the smart play. Ryan believed real estate was the proven road to wealth. Elena believed the market would quietly do all the work for her. Neither of them actually sat down and mapped out what their choice would cost in dollars, in hours, in stress, and in risk before they made it. Over 10 or 20 years, the real trap was never real estate, and it was never the stock market either. The real trap is choosing one of them based on a YouTube thumbnail, a podcast clip, or something your uncle said with total confidence at Thanksgiving without ever running the actual numbers for your own life, your own market, and your own tolerance for a 2 a.m. phone call about a broken pipe. And if you're wondering what happens when someone does both, when they own a property and invest in the market at the same time, letting one hedge the other, that's an entirely different conversation, and the math on that might surprise you even more than this one did. But for now, the next time someone tells you real estate always wins, or the stock market always wins, ask them one simple question. Did you include everything? Because the only answer worth trusting is the one that actually does.